Well, a reverse mortgage allows you to use your housing, right? Your house is money. You're sitting on money. How do you get that money out? By doing a loan. Traditional loans, you'd have to qualify based on income. And so the reverse mortgage, it does just that. Reverse, you don't have to make any payments. That can mean the world for a lot of people that are in a place of retirement. And when I talk to people, everybody, what's lovely about the reverse mortgage is that there's no right or wrong. It's what's your life. It grows with you. There's like a big miscommunication. People think that the bank takes your home. They take the title of your home. And no, everything is still yours, just like on a traditional.
What are the different ways that you can structure a reverse mortgage?
So,
in life, there's a blueprint for everything. There's no need to start over. Hear from industry leaders, those at the top of their fitness journey, and real estate gurus. They tell you exactly how they did it. All you have to do is listen, learn, and execute. This is The Blueprint with Brad Rice.
All right, everybody, here we are back again at The Blueprint with a special edition. This is a mortgage edition. That's right. I've got a Marathon loan officer joining us today. So get ready for a lot of education, but not just education on mortgages. This is going to be very specialized education on reverse mortgages. So whether you know what a reverse mortgage is or not, at the end of this session, you are going to be a pro, and I'll tell you why. It's because my guest today is a pro, and everybody that she talks to, every interview she does, she educates her clients, and they know by the end of that transaction as much as she does. So with that, I'd like to introduce to you Erica Bernard-Webb. And you go by all of that, right?
Yes, I do.
Okay, because sometimes I know when I've seen it on paper, I've used Bernard and then what? So it's Erica Bernard-Webb. And maybe start with that.
Yeah, I should. It's because I've been in the business so long, and I got married in 2000, and so I started in the business in 1989. And so everybody knew me as Erica Bernard. Right?
Yeah.
And so I told my husband, I was like, geez, I can't lose all of my following. So I hyphened. But now I actually wish I didn't because it is so long. I have to be like Erica.Bernard-Webb.
I know. It takes longer.
Yeah.
But, okay, so really cool, very interesting, because you started in 1989. And I don't know why. We've never had the conversation. And typically, I am the one that's been in the business the longest, at least at the company. So you beat me by 4 years. I started in 93.
Wow.
So let's roll the clocks back. Okay. But by the way, not very many people start in the mortgage business at the ripe old age of 12. So it's really great that you started at 12 years old in 1988.
Yeah.
Anyway.
Just right.
What can I tell you? So look, how did you get in the mortgage business at that time?
Well, you know what? I came out to California, and I was actually at my
From
degree.
Where were you?
From Miami.
Okay.
And my degree was in actually broadcasting. And I did not like the news.
Okay.
It was just so depressing. So I did some internships at ABC and what have you, and I thought, goodness gracious, the news is so depressing, especially on, dealing on the background of things. You start seeing, killings and, it's just, and I'm a very upbeat, actually super hyper person.
Yes, you are. Agreed.
Yeah, so I was like, oh no, I'm a very more consumer advocate. Well, back in the 80s, the cable was just kind of blossoming, so you only had network TV.
Yep.
So I thought, my minor was in advertising. I actually tried to get in to Transamerica's advertising department, and I didn't have typing speed.
Oh, okay. That was part of the testing.
That was part of when you had to, I'm really dating myself here, but when you used to go for a job interview, you used to have to do a typing test.
Yeah.
And I never took typing because I used to play the flute, and in high school and what have you, you could do an elective. So I used to do the band.
That's interesting. Wait, okay, so you went to school in Miami, and that was a public school that had all that?
Yep.
Okay. Because I had a private school that I went to that offered all those things, like band type stuff, and I played probably at least 20 instruments.
Oh, really?
Not that I do play them, but I played them when I was going through. Yeah, I want to clarify.
A Blueprint jazz session.
Let's not do that.
Okay.
It will not be good. But I can name just about everything that I played. I mean, we're talking about the clarinet, the flute, the cello, the piano, the guitar, the drums.
We're getting some pretty interesting.
Oh my gosh, so many. So many. So anyway, violin.
Oh my gosh.
Oh man, the memories are just rushing back.
Yeah.
The saxophone, bass saxophone.
I could see sax.
Yeah, it's just so many. Anyway,
but it was an elective.
But all those were electives at this private school. So my public schools, when I went to that, they didn't offer that. So that's pretty interesting.
Yeah, same. And so I went through college and what have you. Never really took typing. I kind of took a class just a little bit of the last year, which was kind of like, hey, just a filler class so that I could get through, and I didn't take it as serious, right? And so anyway, here I go for this interview, and
how many words per minute did they want?
Huh?
Do you remember? Like 100?
Fast.
Like 100 words a minute? It was too fast.
It was fast. That's all I knew. It actually blindsided me because I wasn't prepared for that aspect of the interview.
Yeah.
So when I got up there, because it was a referral, and they were like, yeah, you'd be great. And so I was like, oh, wonderful. And so I get up there, and the room is a room like this with, the old typewriter machines, and it's all the candidates that are going for the job.
That's a lot of pressure.
And they give you just something that you're supposed to type. Everybody has the same thing, and you're like,
yeah.
So everybody's like, and I'm like,
oh no.
And so they looked at me like, she's not getting this job. I got her out. She's not competition.
That's actually really funny and probably a lot of pressure.
Yeah, and I was just like, oh, I'm dead. I was like, forget it. Well, I think that lesson learned here was that they were actually impressed with the fact that I didn't let that affect me. I still went ahead and did the interview, and they were like, look, you don't have the typing speed that we need you to have for this position, but you'd be a great management development candidate.
Okay.
And you'd learn all the aspects of the business, and that's how
So you were hired?
I was hired.
Okay.
And I was hired in their management development program, so I did a little bit of everything, HR, finance, all of it. And then they put me in an office that did loans, and Transamerica used to do loans.
Oh, that's how you got
and
in.
then they taught me everything about lending, and then I ended up running offices, and that was it.
Wow. Okay, so 1988, you get this job with Transamerica. Serendipitously, you failed the typing, so you couldn't be a secretary, and you got put into management. So it worked out pretty well.
Skills.
By the way, for those that are listening to this or even watching on YouTube, we do have a special guest behind the camera because Erica brought her mom, Letitia, with her, and she is really fun, I can tell. So we had a lot to talk. So she's watching with a big smile right now. But okay, so that's awesome. So you got right into management, and then you learned loans. Now, did you originate loans back then?
Yes, actually. Now, I don't know, maybe 93. You probably were still kind of doing the same. Back then, I mean, this is how different lending was because they didn't have FICO scores. We used to actually do the
underwrite
scoring.
The credit.
We used to sit and go, okay, do they live or rent? That's 2 points.
Yep.
And we'd sit and calculate your score to see if you where you fit in the tiers of the loan. We'd underwrite the loan. we would actually type the check for the funding. That branch, it was the branch that I ran everything. So we would do collections as well.
You know what this is doing for me right now, Erica? I got to tell you. Okay, so Erica loves to control the entire process. Now I'm understanding why, because that's what you grew up doing. Mm-hmm. You did everything. Okay, that makes a lot. But this is what makes you so good at what you do, because you have that wealth of experience, that breadth of experience from doing it all.
Title, we were escrow, we were everything.
You did it all. Okay.
The whole thing.
So how long were you there?
So I was with Transamerica. Let's see. I left in. Well, there's some mergers in there, because then they bought Household Finance. So I was with them for till 2000, and then I went into banking, and I went to First Interstate.
Oh, yep.
But then First Interstate got by Wells Fargo.
They did.
Bought by Wells Fargo. So I did Premier Banking and private banking. So then.
Okay.
Again, you do everything for those clients, and
so this is all like you had moved to LA, so all these jobs were in the LA area.
I did, yeah. It's all South Bay, Culver City, Lakewood.
Okay.
And that's pretty much it. Lakewood, Long Beach, all South Bay, Torrance.
Okay.
Redondo Beach, and so different assignments throughout but pretty much those were the areas.
Okay.
And so long and short of it, I stayed on with Wells Fargo, but then they had a hostile takeover situation, and the floor got pulled from under me.
Okay.
And I got laid off. And I was like...
What year was that?
Oh, that was... let's see, what was that, 2002?
Okay.
Like that. And my dates might be off to,
Okay, right around there.
Right
Early
around
2000s.
There, in the 2000s. And so I went out and I went to work for the Federal Reserve. The Federal Reserve hired me.
Wow.
And again, management development. And I was over, well, you know what? Let me back up. Actually, it was a little bit before, because how I got hired by the Fed was because of the Y2K project.
Okay, so it was before. So,
okay. Yeah, so it was right. So
for those that don't know what Y2K is, okay, so as we were approaching the year 2000, there was a big thing, and this also happened about 3 years before that, so in 97, everybody was saying, all the computers are going to shut down in the year 2000 because they weren't programmed to roll over from the 1900s. So all the systems would literally just shut down and everybody would be just dark. That was the worry. And so there was something called Y2K compliance, which meant you had to get into your operating systems and your servers and make adjustments and all that. It was a huge panic, and you had to report this.
The Federal Reserve was heading that up.
They were heading it up, and you had to report this as a business.
So I was one of the people that helped make sure that we are into the 2000s.
Okay.
So.
And by the way, year 2000, that New Year's Eve. and it went from and I don't know about you, but I was thinking about this and I was going, okay, I'm Pacific time. It was uneventful, is right. But I'm there on New Year's Eve. It's Pacific time, and wait a minute. It's already 2000 in other parts of the nation, and nothing happened. Nothing is happening. What a big waste! We had to upgrade computers and spend all this money, but
and we had to have. The Fed was actually we had cots and it was like some serious contingency planning.
Yeah.
And so again, I worked in the public information sector of the Fed, and I was a project analyst as well. So when I landed in the project in the public information, I did the traveling roadshows for Greenspan and for so we would go to educate the public about the Fed.
About the Fed and also about housing?
About the Fed,
Just about the
housing,
Fed.
how rates work.
Because Greenspan's big thing was everybody should own a home.
Yeah, and Greenspan became, was very popular. So at that point, so everybody was like very interested in the Federal Reserve. And
so where was that? The Reserve located in the
for 11th District, which is LA, which is San Francisco, and it's downtown.
Downtown.
The LA location is downtown, but it's all tied to the 11th District, which is in San Francisco. So
you traveled a bit then.
Yeah, so Janet Yellen was, was up and coming at that time.
Yeah, she was back then.
And so we would do the road shows, and we would do tours, and we'd bring people down so they could see all the money in the basement, and it was over the tours, and so that was my role there, and I stayed there for about 6 years when they started kind of doing some changing, and I decided to go and get my real estate license and go out independent.
To sell real estate or to do mortgages?
To sell and both.
To do both.
Mm-hmm.
Okay.
So at that time there was no NMLS.
No, not yet.
All you needed was a real estate license. That's right.
Yeah.
So that's pretty much. I went out independent and did everything, one-stop shop.
Okay, and so you're doing real estate and loans.
Mm-hmm.
Now we're talking it's early 2000s.
Yeah, now we're
pre-crash.
2000, and then everything was great. I really thought I arrived in life.
Yeah, yeah, I bet.
And then the crash hit.
And were you still married at the time?
Yeah, I was still. Same person has gone through the rides. We've gone through the ride together, and So we made it through the crash, like you said, and I still stayed on, and then I went to work for Sanwa Bank.
Okay.
And
a lot of these institutions are just not around anymore.
Yeah, I know. They're all this. So I said, there's a lot of mergers.
Yep.
So I went to still doing real estate, but I also went to work for Sanwa, and then Sanwa got bought by Bank of the West. But I was while I was with Sanwa, I was a compensation analyst. And so I would do the jobs. I would create the jobs and do all the job descriptions and make sure that equity was across the board and raises. And so I was doing that. And then when Bank of the West bought Sanwa, it was another, hey, we got duplicate roles. Yep. And then they were like, you got lending. And that at that point, the market was booming. Yeah. So they asked me to come and underwrite.
Oh.
So I became an underwriter.
Okay, another hat.
Another hat. So I really touched all the little nuts and bolts of this business. So, and so I was an underwriter for about 4 years.
Okay.
And also independently doing real estate. Mm-hmm. And then when they decided to close the loan center and started trying to do more of branching things out to different, patching out different businesses and processing units and made like a big thing. And so then I just totally and completely went 100% independent.
Got it.
Uh-huh.
And then how did you wind up at AmeriFund?
Oh my goodness! Now see, that's
that's more recent. I hope you can remember that.
So I stayed on. Then the boom hit, and my broker, he was in Lawndale, and Lawndale, Manhattan Beach area. He sold to an ERA.
Okay.
And he had two arms. He had the lending arm and the real estate arm, and so life was wonderful because I was doing it all. And so I stayed on, but then he sold, and everybody started splitting off.
Yep.
And so I went on to stay on with another broker, just more doing well, I was still doing both because I was still doing both. And then things got really bad. Like, you remember the dot, what was it called? No, what was it? I don't want to call that thing incorrectly. Where everybody was getting on that list that they're, the implode.
Oh, the implodometer. You're talking about during.
The implodometer. Yeah, because now I'm taking you into like.
We're talking about 2007, 2008.
Yeah. And so the implodometer hit, and I said, oh my goodness, this is crazy. So then B of A asked me to come on and do.
So let's pause there just for a second for those that don't know what the implodometer is. So in 2007, and I know everybody talks about it being 2008, but it really honestly started in October 2006.
Yeah, the writing started.
There was something, a website that was developed by somebody in the business called the implodometer. And by the way, it still exists. It's still up, but and still looks just like it did 25 years ago, or whatever. Not that long ago, but 20, whatever, close to 20 years ago.
Almost.
And and basically, they were tracking the lenders that were shutting down. And because it was almost like every day we would hear about a lender shutting down. And so for originators that were still doing loans, they needed to know where they could send their loans to because all these lenders are just closing doors. It was a real mess.
It was the Armageddon.
And by the way, for nostalgic purposes, we were number 52 on that list. So it was, yeah. And there now there's thousands on there because they've kept track over the years. But yeah, that's what that is for those of you that don't know.
Yep. And so Bank of America was like, can you come back and come over here and do lending and take the territory of the South Bay? And I said, okay.
Okay.
So then I was still doing my real estate and doing lending at B of A, and stayed on until about 2012, where my stepfather got ill, and we lost him. And then I also, during that time frame, took on my dad, who I'm Costa Rican. So my mom and my dad are Costa Rican. And so my dad, I was ending up taking care of my dad. I had him like from 2009 down here. And so I was doing that. And then we decided to go back to Costa Rica to take. He had properties that he had, and my mom and him. So I decided, okay, let's go back. And I went up there, and then I just got off grid and got stuck in a hole.
Okay.
Because life.
It's a little slower there.
Well, life is lovely there, but at the same time, that wasn't the plan. We were supposed to just go for 6 months, get their house up, and, get some things and head on back. Mm-hmm. And what ended up happening, because B of A at that point had, again, changed their stuff too, so they did some layoffs. So I said, okay, this is my little window here.
Okay.
I went back out independent, and long and short of it, while I was there, I was doing work. And my mom had a stroke out there. And then they were like, she can't fly because of pressure. Yep. And she had to recoup there. And she did a good job recouping. And then my dad had some heart issues. And then we had to do some surgeries and stuff. And we couldn't leave there. So I was dealing with them. And then my dad's sister, who has no children, also got ill. So I became the
family
designated
caretaker.
Yeah, this designated. So my life went into caretaking, which I've been doing like reverse all the time. But when I went with Bank of America had opened up a reverse division. Yeah. So I was also doing.
Yeah, that was back when the
division.
banks did offer them.
And then Bank of America sold the reverse division, and so did Wells. They got out.
They all got out
of
reverse.
Got out. So then I went back independent, just doing everything.
Yeah.
And so at that point, they were recouping. We did end up losing my dad, and we ended up losing my aunt. And right at that point, COVID hit. We couldn't leave.
Yeah.
So I got stuck for almost 8 to 9 years until I came back.
And so you came back in.
And we came back in 2021, right at the end, like right when they really started.
Where rates started to go
up.
Yeah.
And then I went so my old colleague at Mutual of Omaha said, Erica, come and do reverse here. And I did, and signed on. But life had changed quite a bit, because right when I had left, all of the Dodd-Frank stuff and they changed to TRID and versus, this is for those out there that don't know, it's just the different ways we
have to disclose mortgages now versus what we did before.
And because of the 2008, stuff, that just to make sure that the consumers really knew what they were getting and how to understand and make those forms more consumer friendly.
Yeah, they did a really great job with that.
Yeah, exactly.
Yeah.
So then I said, okay, but then my mom had another stroke. And so I decided I could not really do what I needed to do at working for Mutual Omaha, so I needed to go back just being independent.
Yeah.
And so I didn't re-up my real estate license because I was like, that requires you to really be out there. But I am going to, for those of you that want to buy.
All right.
I am going to actually.
So did you join us right after Mutual Omaha?
I joined you guys.
And how did you find out about us?
And I was just looking. I was looking around, and Angela and I knew each other, and then she was like, come and so we just started chatting, and I started researching, and then I said, I'm gonna go ahead and go here because you guys have such wonderful. I like the camaraderie, the training. I mean, even though we're all just really, I haven't seen anybody because it's been from COVID.
Yeah.
So we've just we'd see each other, but video, the world of Zoom.
That's right. That's right. This was Erica's first time physically seeing us, and we had a little bit of a breakdown on the way in the office. Everybody started to cry.
So if my makeup looks bad, it's all her fault.
No, it doesn't look bad. All right. Well, great. That gives us the full perspective on, because everybody has a different journey, right?
Over.
Yeah, it's not over. It's just beginning. Just beginning. All right. So along the way, as you mentioned, you kind of got involved in reverse mortgages, and that's really like you do all mortgages. But that's really become your thing. And here's the reason that I know this and how adept you are at these loans, because you and I will work together occasionally on a loan. And there was a couple of times where I said, hey, I want to be on the phone call and I want to listen in. And you're like, sure. And so you took the reins, but I was a fly on the wall. And I was really impressed by not only your knowledge, but how you conveyed that and how you educated the customer through the process. So let's get into the crux of reverse mortgages. So if you were going to define reverse for somebody who knows nothing about them, how would you, just very high level, how do you define a reverse mortgage?
I'd say if you're considering joining the AmeriFund team, it's a really good idea.
We as processors at AmeriFund Home Loans support the loan officers in every aspect of the loan once it comes into processing because we want them out there marketing themselves and originating more loans and supporting more borrowers.
Competitive commission plans are a given, and powerful technology is expected, but what truly sets us apart is our culture. We've built a solid support system for our loan officers. If you're interested in joining the AmeriFund team, go to amerifund.com/careers.
Oh boy, let's see. Well, a reverse mortgage allows you to use your housing wealth, right? Your house is money. You're sitting on money. How do you get that money out? You get that by doing a loan. Traditional loans, you'd have to qualify based on income. And so the reverse mortgage, it does just that. Reverse, you don't have to make any payments. And that can mean the world for a lot of people that are in a place of retirement. It's for people that are 62 or older. Mm-hmm. So in some cases 55 now, some products, but the sweet spot of the product is 62.
Yeah. So, reverse mortgages are, now when you're in the reverse world, you call other mortgages forward mortgages. If you're not in the reverse world, it's just called doing a mortgage.
Yeah, I just call them traditional because even people don't even understand what forward is.
But a reverse mortgage, honestly, is such a wonderful tool and product. And like you said, it's for people that may be house rich. You've got lots of equity, but cash poor. Maybe you don't have a lot of cash. You didn't save up quite enough for retirement. You're on Social Security. You're on a fixed income. Maybe you're living basically from week to week waiting for the next check to come in, or you have family members that are helping you out because you just don't have enough to get by, but you're sitting on all this equity. The problem is you don't qualify for a traditional loan or a forward loan because, like you said, you need to have income to qualify for that in some fashion. Even if it's what we call non-QM, which is bank statement showing cash flow and that sort of thing. And if you don't have that, or maybe you've got some derogatory credit or something else going on, those are not qualifications needed for the reverse loan. So there's two things you need. You need equity in the home, and you need to be over the age of 62, right? And like you said, some is 55, but the majority of products are available at over 62.
And it's a government-sponsored loan. So I want to say that it's not per se, and that's the nice thing is, I didn't say when I was working at Bank of America it was for the reverse mortgage division, and so I handled the South Bay area.
Yeah.
And so. One of the things about reverse is that it's not just for people have the perception it's just that you're cash rich, and it's not.
You're cash poor.
Cash poor, and real estate rich. Not really.
Not only.
No. A lot of financial advisors, for you financial advisors out there, and that's one of the things that you'll probably hear some forward-thinking financial advisors that are starting to look at housing wealth when you look at a portfolio.
Yes.
For example, when the market crashed, people were trying to take their funds. Maybe instead, if you could also do a reverse and put that into your wealth planning mix, and it's also a good tool. So it doesn't necessarily have to be that you're cash poor. That's a
it's a misnomer.
Communication.
Look, I think you're 100% right, and I reference a conversation I had just 2 days ago with a large financial company where they do a full analysis for their clients, which includes the equity that they have in their home, and they may have a lot of money in retirement funds that they're accessing, but they're drawing on that every month. And there's a shelf life to that.
Correct.
And in a market like we have today where it's very robust, we're at the highs of most indices and so forth, pulling that money out is a big difference than if you used your house for leverage and you left that money in to grow. So you're right. It's also used as a financial tool.
Yeah. And when I talk to people, everybody, what's lovely about the reverse mortgage is that there's no right or wrong. It's what's your life. It grows with you. And so each person is different. For example, somebody that, like you said, doesn't have an existing mortgage, if you do have an existing mortgage, it can, for some people, just paying off that mortgage, and now you don't have to make a monthly payment every month. And you can use your Social Security or in your pension to just live and not have to worry about making a mortgage payment. That's why they call it reverse.
That's
right. So that makes a big difference. You're not obligated to make a payment. You can if you'd like to, but you don't have to. Whereas on a traditional loan, if you don't make that payment, it starts marking your credit, and we start moving towards a foreclosure.
That's right.
Situation. So that's the nice part about reverse, but you can also, I can give you a ton of scenarios.
Well, let's ask you some questions. So what are the different ways that you can structure a reverse mortgage?
So, like I said, for example, I just gave you one. So for some people, if they could just pay off that existing mortgage, that'd be great. Sometimes if there's enough equity, they might be able to get that and have a line of credit. Or you could take monthly payments. Some people need income. They'd like to take, XYZ dollars every month, and that would be helpful to them. You can structure that. You could take a lump sum and say, hey, I want to go travel the world. I want to fix my home. I want to help my kid. I've done deals where somebody says, I don't want to wait till my child passes away. I want them to get housing wealth now. Yep. So they get, but I can't help them because if I take out a loan, now I got a payment. So if I could now use this reverse mortgage, not have a payment, and give my kid this down payment money, now I'm helping them.
Yeah.
So I've done loans where you're doing caregiving for people that need help, and Medicare is not going to pay for a caregiver to come in and help you. They'll give you some help, but not that kind of help. And so those kind of things, or I've done loans as a purchase. You could do them as a purchase. A lot of people don't know that you could do reverse for purchase.
Explain a reverse mortgage for purchase.
So reverse for purchase, basically, and sometimes we call them, which that doesn't necessarily mean this, but right sizing is or we also do a lot of gray divorces as well. So sometimes you need to. You have a home and it's too big, or you have 2 stories and you're now like, my knees are shot and I can't get up these stairs, right. Which I have to think about because I have a tri-level. So pretty much you actually could sell your home, use some, instead of using the equity that you get out of the home. So let's say for example, your home's worth, just let's make it easy. It'd be nice if they had these prices, but $100,000 is the value of your home. You sell it, and now you want to go buy something that's $150,000. You can, instead of taking all the $100,000 from the sale of that home, you can take a percentage of it and qualify for the reverse, and now you still have some of the money that you took out, and you're not putting it all back and saying, well, I just got to buy an all cash offer situation. Now you can have some money that you can have growing, helping you meet your needs.
And still not have to make a mortgage payment.
Correct, and not have to make a mortgage
payment. So, for example, I've got a loan in process right now that is a reverse for purchase, and it is somebody who's downsizing. Mm-hmm. She's single now, and she's older, and she wants to be in a single-story home, mm-hmm. and she's got about $213,000 of equity, and she's taking that equity to use as a down payment in a reverse mortgage on her purchase that she'll never have to move from. Yeah. So explain the benefit of a reverse mortgage being considered a permanent mortgage.
My advice for someone selling their home: number 1, do it yourself and save. Number 2, use HomePie.
HomePie makes it easy to buy or sell without an agent. I can list a home in minutes and start receiving offers right away from buyers.
When we discovered that we didn't have to lose $40,000 in agent commission just to upsize to a larger home, it was an obvious choice.
List your home for free at homepie.com. Keep your piece of the pie.
What do you mean?
Meaning that they never are forced out of the home as long as they're making their payments.
So there's some basic rules on the reverse, right? So people say, well, hey, if you're not making a payment, how does the bank make their money, right? So the bank is still going to make their money, or the investor or the financial institution is going to make their money. How they make it is that the interest is being added onto the balance, and that's what we call a negative amortized loan. So you're not making any payments. The bank's going to get their money when either A, you pass away, you can sell, you could refinance. All those options are still available to the person, regardless of, there's like a big miscommunication. People think that the bank takes your home. They take the title of your home, and no, everything is still yours, just like on a traditional. And then as far as the main things that you have, the main rules, I should say, for the reverse mortgage is it has to be your primary residence, so it can't be an investment property vehicle, and it has to be your principal residence. You have to pay your property taxes and insurance, and you just have to do basic maintenance. Like your property can't look like Sanford and Son, for those of you that know that.
Right.
It has to be kept.
You have to maintain.
Yeah, you have to maintain.
It has to be livable.
Right? Yeah, that's right. It has to be livable. As long as you do those things, then you meet the guidelines. It's just about where you are in the age, how they convert to see how much you can qualify for. But at the end of the day, it has really nice features as well, because this is a government-sponsored product. So the product has evolved through the years, and so there's always that they take your house, they're not going to leave anything for your heirs. There's a whole lot of misconceptions, and then after you talk, I encourage people to talk to a professional so that you actually can learn what how the product works, first of all.
Yeah.
Because every time I talk to them, they're like, "Oh, I thought this," or "I thought no."
That's right.
So no, you are the owner of your property. If something happens to you, your heirs have 6 months to a year to pay off, because you could get 2-3 month extensions from the time that you pass.
Yeah.
So
let's drill down into that for a minute, because that is a common misperception that, hey, the bank's going to take my home if something happens to me. So we already explained, or you explained, when you get a reverse mortgage, as long as you are living in the property as your primary residence, which is more than 180 days a year, so 181 or more, that's your primary residence. So if you're in, let's just say, Phoenix, Arizona, and you like to leave when it gets too hot there, that's okay, as long as you live there at least 181 days a year. That's primary residence. You've got to pay your property taxes. They can't go delinquent. You've got to keep your your homeowner's insurance up, because that's what protects the lender for what they're loaning you. If you do those things and you maintain the property, they can never kick you out. And it doesn't matter if at some point in time the property loses value. Let's just say there's another crazy market crash and you owe more on it than it's worth. It doesn't matter. You can continue to live there, or the second spouse, if there's more than one of you, until the last one passes away. So now what you're talking about is what happens after that event, after that life event. What happens to the home? How does it make its way to the heirs?
Well, let's back up a second, too. Something that you just said just triggered me to add that as long as you stay in the home, like you said, 180 days, so 6 months, you can, rent a room. Some people ask me that question. Can you rent a room? Yeah, you can, as long as it's your primary residence.
Right.
Well, how do they know it's my primary residence, Brad?
How do they know that, Erica?
How do they know, Brad? They actually, every year you'll get a certification letter that comes to your home around the anniversary of when you closed your loan, and they will ask you to
certify
that you're still living.
Yep.
Right? Because some folks don't tell their heirs and then the heirs don't know, and so that's why that certification letter comes. And every year you certify, stating that the home is your primary residence and you're still living, basically. Yep. But let's fast forward to if the person unfortunately passed away. A lot of clients that do look at the reverse mortgage, they feel worried about leaving their loved ones with a burden. And so that's why they're always like, no, I don't want to touch my home because I'm trying to leave it for them, and I don't want to, and so meantime, they're suffering because they could be using some of that equity to help them. You're not taking all the equity in your home. Your house still continues to grow in equity and value, and you're just taking a portion to help you in your living now, while you're living now. And when you pass, that equity that's there still belongs to your heirs.
That's right.
So they have 6 months to, they report the passing of the loved one, and then they have 6 months if they want to buy it, right? The same things that they would be faced with in a traditional. Yep. Right? And I always tell people, if something happened to you right now, oh yeah, I have 3 kids. Okay, so what? I want all 3 of them to have this equally. Guess what? How are they going to do that? What are they going to do? Well, they're going to have to sell. Or, oh no, but my daughter wants to keep the house, but my 2 sons don't. Okay, so she has to buy them out, right? Because you're leaving. So those are the same issues that
they don't change regardless of the product.
Don't change regardless. And then so people are like, oh.
Yeah. So this is all true and really great information. What happens if at the time of passing there's no equity?
Well, that's really good too. Oh, well, 2 things too. Let's talk about 2008 when things went upside down for a lot of us. So let's say, you've had the reverse mortgage and I gave you $200,000, and now the market did a correction of crazy, because I can't even call it a correction. Let's just say it crashed. And the value is now $50,000. You pass away, right? You're worried, oh my gosh, I'm leaving my kid with a situation that they still gonna have to pay this $200, and now the value is $50. What happens? Well, because it's government sponsored, the bank cannot take more than what the value is worth at that time. Plus, you could get it so they wouldn't have to pay that back. It's called a non-recourse feature.
There you go.
Yeah.
So it's a non-recourse loan, meaning the heirs or the estate don't have to pay anything over whatever the property satisfies for the payoff of the note.
Yeah,
but there is another feature, right? What's that other
you
feature
tell me
for the heirs?
Because you when you were listening, and I said, "Oh, that's very good."
Oh.
And I actually like the way you said it.
So here's the other feature. Not only that, but let's just, let's use a better example. Let's just say that people are living longer than they used to. Let's just say Letitia lives till she's 135, which there's a pretty good chance of that.
Yeah.
And at the 135, she owes $950,000 on her home that's valued at $600,000. But you love that house. You don't want to move out. You want to keep that in the family for centuries. You can then, as the heir, acquire that home for 95% of the current value based on the appraisal.
I love it.
So you get a discount, and all the other money gets wiped out. So it really is there to protect the heirs and protect the property.
Right. That's right. And actually, when we talk about that feature, I love the way you do it. Actually, really, and that's why I made you do it.
Okay. Fair enough.
I like the way you actually explain that. It really makes the light bulb come on for a lot of people. It just makes them feel
Because I think that's the worry. The worry is that, because we lived through the crash and we saw that, and even though that's very unlikely to happen again, there's a scar there.
Yeah.
And that scar it could happen.
Yeah.
And so because of that, there's this protection in place.
Yeah, that's a big sigh of relief for a lot of people, and because they don't want to leave their kids with a burden. And so that really means the difference. And the other thing that I was going to tell you, too, is that so let's use that same example with regard to the market crashing. And let's say you have a line of credit. We did your reverse mortgage, and now the market crashes, and you have a line of credit. When that happened in 2008, people probably can relate to this that had line of credits. They got
cut
closed.
off.
They got cut down. If you had a $100,000 line, they're like, now it's 10 or 0 or it's closed.
If you had a line of credit, any unused portion you weren't allowed to access anymore.
The banks are allowed to, because of market conditions, they're allowed to make adjustments, and they did. And so a lot of people that had home equity lines of credits for whatever, for emergency funds, for that was gone.
Yep.
The rug was pulled from under them. But with the reverse mortgage, your line of credit is your line of credit. So even if the market did that, they cannot say, "Oh, we're going to make market conditions now." No,
So let's talk about that feature, because like you said, there's a few options when you do a reverse mortgage. You can just do the reverse to pay off your existing note, and that's it. Mm-hmm. You can pull a lump sum of cash out and use that cash in whatever way you see fit. The other thing that you can do is get a line of credit, or a combination of lump sum and line of credit.
Or monthly payments.
And then the fourth thing is an annuity. So that's getting a monthly payment each month out of that equity. But let's focus on the line of credit for a second. Tell me the nice features about this line of credit. You named one of them. You said they cannot turn it off at any point in time based on market conditions. That's a big deal. What else?
Yeah, that's huge. So for your folks that are that have a good wealth plan, right? That's a wonderful. That's where you should do your line of credit, because when the market has some issues, now you have this
safety
tool that's safe, that's never going to change. And the other feature is called a credit line growth.
Yes.
Aspect. So what that does is, it's, for lack of a better word, it's allowing you to get access to additional equity. And so if you're not touching your credit line, and that credit line is there, as every year goes by, your home is growing in value, right? So they're giving you a percentage. A percentage to be able to access additional equity.
So your credit line grows over time.
Your credit line grows. However, I want to make sure, because people sometimes think like, "Oh, that's wonderful. that's interest earned." No, it's not. It's not. It's just giving you access to additional equity, which is nice because you wouldn't have to apply for additional.
Now, how is that calculated? Is it based on market conditions and growth of the
based
value
on
of the
rate,
property?
It's based on the
Only on the rate.
Yeah, it's based on the rate, which depending on the product that you take, there's products that are tied to the 1-year Treasury plus a margin, and so that would be if we were at, or there's some fixed rate products that range anywhere from 6 to 8 to 9%. So depending, so you would get access by that percent, whatever that rate is at that point.
Okay, so let's clarify this. So first of all, the line of credit's available on both adjustable and fixed rates. No.
Fixed rate, no. Only it has to be on the
only on
adjustables.
Okay, so the line of credit is available only on the adjustable rates, not on the fixed rates.
The fixed rate, you got to take all the money.
The line of credit grows at the same rate of interest that you're paying on the principal balance that is also growing because it's negative amortization on the loan. So every month that goes by, your principal balance, when you don't make a payment, goes up, right, by that interest, but your line of credit also goes up by that same interest percentage.
Correct.
So that's a really great feature. Now, do you have to establish a line of credit at a certain minimum amount?
No, and you can make changes, by the way, with all those features at any time. So maybe you start off with a line of credit, and that's why I was talking about the beauty of this product is that it grows with you. So maybe I start off and I'm like, no, I don't need to touch anything. I don't need anything. I just want to have this line of credit for if I need to, do anything special, fix my home, emergencies, whatever. But then later down the line, you say, you know what I need to actually, it'd be great to get some monthly payments, annuity payments. If I could get, like, for the next 2 years, I don't know, $800 a month or $1,000 a month. So then you could go back and they could calculate, and you could have a combination of a line of credit and a combination of payments for a year or 2 years or 3 years. Or you could say, I just want lifetime payments.
Okay.
You can make changes at any time with what you've already structured.
Explain the lifetime payments feature.
The lifetime is just from inception, and again, you could switch this. So you might say, you know what, I don't really need my equity, but I'm looking for like additional income every month. And so if I could just get this additional income every month, I'm great. I don't need a line of credit. So they'll take whatever money you qualify for and they'll amortize it out based on life expectancy tables, and they'll say, okay, you could qualify for whatever the amount is based on where you are in your age to, at the time the life expectancy tables is 100, but we are.
We're exceeding that in many cases. So when you say a lifetime payment or lifetime annuity, it literally will go for your lifetime.
If you make it to 101, it's going to keep paying you.
It's going to continue. 102, 105, it'll continue.
It's going to keep paying you.
Now, the growth on the equity line is based on the unused portion, isn't it?
Correct.
Okay.
That's good.
If you're not, if you use the line of credit, but you leave a little bit available, that little bit available continue to grow, so you have even more of a line of credit. But what happens if you use the whole thing?
If you use the whole thing, then it's not getting the growth.
You won't get the growth feature.
You won't get the
You'd have to pay back some of it.
You'd have to pay something. And you can. Remember what I said. You're not obligated to make payments, but you can. I have some people that want, if you make no payments, you have no write-offs, for example. And I'm not a CPA, but you can talk to your CPA.
Yeah.
But, for example, if you did want that feature, you might say, okay, at the end of before the year end or every quarter, I'm going to lump something down. And so then, yes, if you were at a zero and you put something down, now you still have access to those funds. So you can manipulate that. Right.
And I think that's a really good point that you made, because if you're looking at the advertising for these, if you're talking with an experienced originator, they're always going to use the term, you may not have to make monthly payments. They don't tell you don't make monthly payments, but you don't have to, but you can. Correct. Right? So if you say, look, I've got income coming in, I don't want to have to make the monthly payment because some months I want to go do a 60-day cruise and I don't want to make a payment while I'm gone or whatever, then you don't have to. But I'd rather try and preserve the equity for my heirs and not chew that up because I don't need to. I like the flexibility of doing one or the other. You can make payments when you want to. So that's a really good point. Yeah. Tell me what happens. You mentioned tax, and I know we're not CPAs here. We're not tax advisors. This is nothing like that. But we just want to talk a minute about what that means, because in a loan where it's negatively amortized like this, a reverse mortgage, and you're not actually paying that interest in the year that you're accruing it, you don't get that deduction. But what happens if you do sell that property or you do refinance into a traditional mortgage? What happens with the amount?
You'll be able to use your CPA will be very thankful for that because you'll be able to use that as
you'll have that lump sum of interest that is accumulated.
And your heirs will have that. So that's another that's a really good point, because worrying about your heirs, right? You're when that time comes and they need to settle your estate, whether that be that they can utilize all of that deferred interest as a write-off
to reduce the tax impact.
Exactly.
Okay. So, again, a lot of really great features. People have been tainted through the years, and this all comes from, honestly, it was from early 80s when insurance companies ran the reverse mortgages.
Correct.
So you really got to learn the history of reverse mortgages. When insurance companies ran them, there was this thing where title was transferred. There was this thing that when you passed away, if there was it was shared equity. So if the owner passed away, their insurance company partner would get that extra equity. Like, that's the way that was designed really early. But I'm talking about that has not been around since the 80s. The HECM product, the government insured product, was the beginning of not doing that and taking the ownership away. Right. And now there's what they call proprietary products. Correct. Can you explain what those are as compared to HECMs? Okay, so proprietary,
first of all, HECM stands for Home Equity Conversion Mortgage, and that's basically just reverse mortgage. That's what you're converting some of the equity in your home, right? And so the proprietary products are, let's call them jumbo products, for those property values that are over $1.5 million. Those products work. It doesn't not always. I mean, you could even be under $1.5 million. There are some products, but they basically copy the same guidelines and values and features as the HECM, because the HECM is government sponsored. HUD, if, for example, back when the market crashed, people were making runs on the banks and who has my loan? Who's my investor? Where's my money going? Yeah. And so the government takes over your loan, so you're protected. The government will take over your loan and manage it and what have you. They can't change any of the features, but they will manage everything to that. So that's the extra protection, and depending on on that product, you are paying mortgage insurance, and that's what you're paying for to make certain that you're protected if anything were to happen.
Okay.
But on the proprietary products, they copy and offer the same protections for the loans, and they go for properties that are over, like I said, $1.5 million. Whereas with the HECM product, we are
capped.
You're capped. That's a nice word. Yeah, capped at
certain loan amounts
whatever
based on
the value
area.
Is for your area. Exactly. So if it's, for example, California, if it's $1,096,000 and your house is worth $1.2 million, your house is worth $1.2 million, $1.3 million, $1.5 million, they're going to do the calculation at $1,096,000, and then they do a calculation based on life expectancy, your age, and they come out they come up with the percentage of what they will be able to offer you on a reverse mortgage product. Whereas on a traditional, if it's your house is worth $100,000, we lend at 80%, 75%.
So the proprietary product allows you to kind of, in certain circumstances, exceed those loan amounts.
Correct.
So to help people that may have a loan amount of $1 million or $2 million,
and use that equity
and a property value of $4 or $5 million.
Yeah,
right.
And the calculation calculates that. So if your house is worth $5 million, 10 million, you're
you can
able
still
to
do it on those proprietary products.
Correct. And I've done quite a few.
Yep. Yeah, and I've got a couple in process right now that are over $1 million, and those have to be proprietary. But the other part or feature is some of them allow the younger age. So you mentioned as low as 55.
Okay. Yes, that's
right?
true. That's
and
55.
so tell me
Depending
about
on your
that,
state,
how that
depending
differs.
on your state. And
Are you a tech investor looking to shape the future of real estate? HomePie is the #1 for sale by owner marketplace, and we are revolutionizing the way homes are bought and sold. I'd love to hear from you. Just email invest@homepie.com and let's chat. Now back to the show.
It's just they've lowered, like California. There's a handful of states that they'll allow 55. Like Texas that's just the state of Texas will not. You have to be 62. But if you're 55 and older, you have good equity positioning. You could take advantage and do a proprietary, and eventually later, by the way, you can refinance reverses, right? So if the market changes or later down the line, you've used up some of the equity and now there's, the market has gotten better in rates and what have you, you might say, hey, I want to refi this and tap into more of that equity.
Yep.
Exactly. So I've done quite a few refis as well.
All right, so you mentioned basically there's 3 factors involved in qualifying for a mortgage. You mentioned that it is your age, it's your equity, and it's your occupancy. It has to be owner-occupied. But there is one more thing, right? And it's something that's called a LISA, L-E-S-A, and that dictates what other documents are needed, right?
Okay. Well, actually, I thought you were going to say something else, so I'll get you on that. The LISA is called a loan estimate set aside. Basically, it's just a escrow account. So if you said something very important, which is the property taxes and homeowners insurance. If you don't pay your property taxes and homeowners, or you've been late on your property taxes and homeowners insurance, they will still consider you for a reverse mortgage, but you would have to have where the lender pays your property taxes and insurance. So they will hold that money, and that doesn't necessarily mean you don't have to actually even be delinquent or have paid delinquent. You might just like that feature because you don't have to want to worry about it. And so you might say, I don't want to worry about having to pay my property taxes and homeowners insurance, Erica. I love it. I love that feature, and I want to do that. So they can set it up. They set up the LISA, and that way you don't have to worry about paying your property taxes and insurance. It gets paid by the lender. So that's how the LISA works.
In some circumstances, the property has enough equity to qualify for covering the loan estimate set aside or that escrow account for taxes and insurance. In other cases, isn't it true that you have to provide income documentation for that?
You still have to provide income documentation regardless of the LISA. Reverse we don't look at it like a traditional loan where we say, okay, you make $1,000 a month, your debts are $500, you can't go past 50%. If you do, you're declined. But they do have what's called a financial assessment. Okay, and so they do assess that there's a calculation, and it's too brainy, but
the system does it.
The system does calculate based on living square footage and what your income is. That they have a percentage that you have to be at, and they'll calculate it because again they're doing life expectancy. This product moves with your life. So if you live to 100, it will keep paying your property taxes and insurance. If you never refinanced it, touched it, paid it off, it's going to continue to make those payments. But also the other thing that I thought you were going to say was counseling.
Yeah. Yep.
So maybe you're gonna segue there. If you're interested in doing the reverse mortgage, it's not a product where it's like, oh, I want to do it right now. Let's sign up. There are steps, and because our senior population is vulnerable, and people take advantage. The government, one of the things that the government has done is made that the clients have to be counseled. So I'm going to talk to you about the product as a professional, and then if you say, yeah, Erica, I really like this, I want to do it, then I'm going to give you a proposal package. You're going to look at the list of HUD-approved counseling agencies, and they're going to counsel you on the product as well, because they have no skin in the game, right? They're not a salesperson. They're all about education. And it should match what I told you the product is.
Yeah.
So, if it doesn't, right, then at least like, oh, that Erica, she's a crafty
It's a
sales.
red flag. Yeah. No, that's a really good point. And so this is a protective measure that's put in place to protect our seniors, to make sure that if they are moving forward on a reverse mortgage, they know what they're getting into. They know all the features. They're able to ask the questions. And so a reverse application is done in reverse also. We can't take an application until you've done the counseling. So like Erica was saying, you speak with a loan officer who specializes in reverse. They go through all the features like we're going through today. And if you're listening to this show, you're going to be pretty well educated to begin with. But you learn all about it and you think, okay, this may work for me. But now you have to go through, you get the proposal. We don't tell you who to call, but you've got a list of independent third-party counselors that you are obligated to call. Some are free and some charge $50 or $100
some
or
have
$150.
grants. I mean, you could pay up to $225 low on the high side, on the low side.
But
like
you're
you
picking
said.
it.
Yeah,
you
you're
schedule
picking,
it.
You pick it, and then they call you. They do the call with you over the phone for about roughly an hour. And once you
ask questions, they tell you all the features.
Sure.
And
you could have family members on with you.
Good
I
point.
encourage, like, if you have loved ones or children that you would like to learn about the product or be there.
Nope, we got a phone going off.
I think it's my mom. Is it yours?
Oh, it's in the purse, I think. No,
Can you grab
something
that?
like that.
Back after this commercial break.
There you go. See, you were in broadcasting. That's funny. So as you were saying, look, this is done to protect the seniors. You do the proposal, you go over everything with them, they contact a counselor, they review that together, and then they issue a certificate saying you've done the counseling. Then we can start the process with the application.
Correct. And even still, like, some states have where you still can't have, there's like what they call it a cooling off period.
8 days.
So you still have to wait. So it depends on what your state is. It may not apply to your state. But, I was saying, too, if you have loved ones or advisors, I mean, I've done attorneys, estate planners.
Bring them all in on the call.
Yeah, I get them all in. Anybody that you value, that should be somebody that you trust for their opinion and advice to guide you, is more than welcome to.
Yeah, and you know what, that really does work out well, because if somebody is super hesitant, but they're advisors or their kids get involved, and they're like, Mom, Dad, this is right, we don't need your money, we're helping you out. This happens a lot, like where the kids are contributing or helping the parents to live, and like, just use your equity. We don't need that equity. We want you to use it while you're alive. And that way we aren't burdened with having to give you money every single month. And so
it's the best of both worlds, because you're, like I said, you're accessing some of your equity, and you're still, most people want to leave some generational wealth, right? So you're still being able to do that. But I think, my mom has a reverse mortgage.
There you go.
And
my parents did too, by the way.
Yeah. And so, I mean, just exactly to what you were saying, it's like, well, I want to make sure you're okay and you can do the things that you want to do, and not have. So, I mean, I'm happy that if, Lord forbid, something happened to her, she wants to leave something for us kids, but at the same time, that's not, I want you here.
And enjoy.
And
enjoying your life.
And why should I see you struggling when you're sitting on money? Your house is money, folks.
And it's theirs that they earned over a long period of time.
Over time. So enjoy some of it.
Yeah.
Just enjoy some of that fruits of your labor.
What other things do you want to share about reverse mortgages today?
Just, I think it's more just to dispel myths. I think one of the things that I'm going to be kind of coming out a little more myself. I'm not very social media friendly, but I'm getting myself out there now. So this is a good, this was a very good icebreaker and introduction to me. And I really want to educate people to not be afraid of them. And also, I think one of the big things is that, people ask about reverse, but all you see is celebrities, selling. And so it kind of, gives a bad, because, they don't really explain the product. They just tell you to call this 800
That's
number.
right.
They herd you to the 800 number, and then you get a nice pamphlet. And the pamphlet is lovely and informational, but it's nothing like actually talking to a professional that can really sit down and really get down to the crux of
And what Erica's
your
talking about
situation
is there's a company, AAG, they're not doing the marketing anymore because they were acquired a while back, a couple years ago. But your Tom Sellecks, your Erica Stratas, and those, people recognize this. They would see late night television about the reverse mortgage. Look, to some extent, it was good. It created awareness that this existed where most people don't know it existed. The banks do not provide reverse mortgages. You cannot go to a credit union for a reverse mortgage. And 98% of mortgage companies do not offer reverse mortgages. Guys, this is a unique product. We at AmeriFund have a division of the company called Reverse Loan Solutions, of which Erica is a part of, where we require our loan officers to have a certification, to be certified to even offer these loans. If they aren't certified, they can't do it. They're so different than every other loan. So what you've heard today is one of our experts, right?
Wow,
and,
thank you for that.
And you are a wealth of knowledge. And I will just say this, we skipped around a lot, but you have, because I've heard it twice now, you have such a methodical way of presenting this during the interview process where you're educating and you're kind of walking them through step by step that if you're thinking about a reverse mortgage, if you're even thinking this is the right thing for your parents or your grandparents, reach out and do that initial interview. It doesn't cost anything. It's super educational. Remember, we don't even do the application until after that's done. You get the proposal and you go through independent counseling, then you do the application. So there's really no obligation through that whole process, and you owe it to yourself. We are leaning into this product. I think this is a super valuable product. I think we've helped so many people, thousands and thousands of people, that afterward go, wow, you really changed our lives.
Oh, yeah.
And there's not enough that are offering it, and we're going to keep leaning into this. So, Erica, if somebody is thinking about a reverse mortgage, right? It's your specialty. You do others as well. So if they don't fit the reverse, you could present them other
Correct.
other
we can look
products.
at other options. But I'm very, very bullish, as they say.
I agree with you.
On
But
reverse.
how could somebody reach you?
Well, you can reach me at Erica.Bernard-Webb, there you go, at AmeriFund.com or reverseloansolutions.com. And then my number is 310-404-4986. And of course, you can also, Brad knows how to get me, if those of you that know Brad can also reach out. And I'm just, out networking in the community as well, because you professionals out there, you financial advisors, CPAs, estate planning attorneys, caregivers, we all know some seniors that can actually use this product. And I think if anything, if you've just even keep it in your, maybe right now you don't have somebody in mind, but we all have folks that are 55 and older that could possibly benefit from this product. And at least by you listening to it, you realize hey, it's not so, you're not obligated, and it's not going to cost anything to learn and see and educate yourself. And so that's what we're out here trying to do, is educate and be of service. So
I love it.
I
love it. And like you said, reverseloansolutions.com, and you're on there. You're an originator on there, so they can get to you through that website as well. You'd be doing yourself a service to reach out to Erica. Trust me on that. So you are as lovely in person as you are on the phone and on video. And Letitia, it was really incredible to meet you. And guys, that was another edition of The Blueprint, special edition, Reverse Loans with Erica Bernard-Webb.
Thank you.
Okay, the long version. Maybe we do something shorter for you for your email. But that said, again, guys, if we brought you value, you like what you heard, please like, subscribe, follow, share this with your friends. All that stuff helps us grow, bring on really great information like we did today. And we'll see you next time on The Blueprint.
Okay, don't forget the thumbs up.